are there lots of cracks in corporate credit, and is that warning us of danger to come?
Well, you know the right guess, and so correct again.
So that's a no, but why?
So here's what I think about credit. Credit markets are behaving really, really well. Volatility on equities out, a good from 15 to 25 vol. And equity markets haven't traded down 10%. So what have we seen in credit? IG is out 15 basis points. High yield is out 50 basis points. One might say from the tights, all-time tights, that's too much. But look at price. The price hasn't budged. HYG, which is the ETF for high yield, the price was 79 on February 19th when the S&P was at all-time highs of 6,147. Today, also 79. The price hasn't budged. So when investors look at their book and they look at no price deterioration in credit, and then you go to private credit, and in the private credit market, we're having a really good time putting all this capital to work, generating these 12% returns. And so what's really happening down beneath is people rotating out of equities, out of growth in particular, which is why you don't see kind of this bump in the marketplace for Mag 7 while the other equities are rallying, and you're seeing money come into credit, supporting the credit market. So the credit markets are incredibly stable. Vol's out a lot. You think high yield spreads would be out 100 basis points or more in this type of vol, but they're not. They're holding in very well. In fact, price hasn't moved, either for loans or bonds, in any kind of meaningful way.
So we don't need a Fed put or a Trump put for this to work for you?
Not at all. We can talk about the put in a second, but not at all. I think, what's happening right now is policy measures coming out of Washington, both with respect to tariffs as well as government expenditures, is going to result in the economy growing not at 2% or 2.1%, which was what the blue chip economists and the Fed had thought originally coming into this year, but growing more like 1 to 1.5%. Because it's going to feel like austerity that we've seen in Europe for years and years without the big government expenditures as they pull in the reins of the big deficits. And so as long as the economy grows at 1%, credit markets are dancing and singing, having a great time. Meanwhile, equity markets are suffering, and they're not going to show a lot of appreciation, going to show a lot of volatility through this transition period. So I think credit is the place to be. It's the golden era of credit. As it respects to the Fed put or a Powell put, no, I don't think we're going to see a put down 10%. I came on, at the beginning of the year and said equities would be down 7% this year. 10% from the highs. We definitely see a correction after back-to-back 25% gains. It's exactly what we had. And so a correction and a bounce off of that level and that level holding, there's no correlation for that to recession. And you'd have to see a recession really to have crack in the credit markets, or recession to see a Fed put. And so the Fed's meeting this week, not a shot they're going to ease, and they're not going to talk about easing at this point because inflation's still a little bit too firm for them. And the economy may slow a little bit, jobs may slow a little bit or inch higher, but that won't have any impact really on credit. Having said that, you'll want to avoid certain sectors and lean into other sectors, and that's what we're doing right now in our book.
Okay, let's talk more specifically about where you're leaning into and what you're avoiding.
So I'd be avoiding what you know to avoid, which is the autos, right? And there's some downgrades that are probably going to be happening there with respect to credit ratings, as well as some earnings pressure you'll see in the autos. You'll see that some pressure as well in the home builders and the airline. The airline stocks are down 30%. We're doing a lot of aircraft leasing, and we've done a bunch of engine aircraft leasing in a private ABL program. And so we're very prolific right now, but not the unsecured debt, and I would avoid the equity at this point. So what we're leaning into, we love pharma, and specifically within pharma, because it's not a cyclical business. And I don't know if you've been following the story, but Endo filed for bankruptcy. Mallinckrodt filed for bankruptcy. They both emerged from bankruptcy and last week merged as companies. And so we own a lot of the debt that is now the equity of the company, and we think it's the cheapest equity in the world in the pharma space, because today, in the stock market, you can buy it at a 5 times multiple, a big discount to the other farmers, and it's printing cash. $1.4 billion of EBITDA on a pro forma basis, generating nearly $1 billion of free cash flow. And we love that company on a combined basis. It's growing. Its debt is only 2.3 times debt to EBITDA, which is very small amount of debt for a company like that to emerge from bankruptcy. So it's incredibly healthy. And so I like the debt, but I really love the equity. That's something we're going to have in our position for a long time to come because it's a tremendously undervalued company. So that's one type of special situation that we're buying. We have a couple other situations in the marketplace that I can't share with you now, maybe next time on the show, because we're in the market accumulating it, today, last week, and in the coming weeks.
You said you're avoiding autos given the tariff situation. Makes a lot of sense.
Yes.
They're also exposed, of course, to consumer sentiment and consumer demand. And there are a lot of question marks about consumer demand, given the uncertainty, given the job picture. How are you looking at the consumer sector overall? What would present good value right now?
There's a lot of good value in the consumer sector. So while I mentioned the home builders, home mortgages, for instance, second liens, HELOCs, tremendous value because it's secured by the home, and we've seen a lot of appreciation in home prices. And so although I think the homeowner is a bit stretched, there's so much value in what we're buying in the loan market because of the LTV attachment point. If we can be at 50, 60, or 70% LTV, we have a huge margin of safety. Now, on the other hand, I would be avoiding or downplaying some of the consumer unsecured debt. And there's installment loans and debt consolidation loans, and you got to be very, very careful. It's a bit of a trap sometimes because they offer very high yields, but also very high loss rates.
Right,
so on a loss-adjusted basis, one might not make the kind of return they expect to make. So we're downplaying the consumer overall, but we're leaning into the loans that are secured by property as opposed to loans that are unsecured.
So where does that leave like commercial real estate, for example?
Very, very esoteric, very, very idiosyncratic type of investments that we're making. So the esoteric part might be the fact that we own a huge amount of Freddie K's, which is the multifamily tranche, the lower tier tranche of multifamily loans that have been sold from the Freddie Mac's balance sheet. And so we love that. We have a huge position in that, and we're not letting that go because it's throwing off enormous cash flows. And so we like that. In terms of real estate lending, look, we're still being very cautious to office because it's going through a transition that will take years to go through. I think retail, you've seen kind of the big pig go through the python and see now, years later, who's been Amazoned, right? Who's been able to survive, what properties have been able to thrive, and what properties. And so I'd actually be leaning a little bit into quality, high-yielding, cash-flowing retail. But we always love the consumer, so we always love multifamily. And we love our elderly, so we're putting lots of dollars into senior living as well in terms of where we're making our commercial real estate loans.